Your 401k might be the biggest savings tool available, but how do you maximize the contributions you can make, utilize the best investments available to you, and withdraw the funds in a tax-efficient way? Today, we're going to discuss the different contribution types, including salary deferrals, profit sharing, and the mega backdoor Roth. Rarely discuss options available to you for investing with self-directing, and explore tax-efficient ways to access and use the money you've worked so hard to save. If you want to maximize your retirement savings and minimize your taxes, you've come to the right place. By the way, if this is your first time here, welcome. My name is Navi Miraj. I'm a CPA who helps business owners save more and make smarter financial decisions through practical tax and wealth building strategies. I share these insights right here on YouTube, and I also have a course you can find at navimirajcpa.com. More on that later, but for now, let's dive into the 401ks. Let's start with the basics. What exactly is a 401k? A 401k is an employer-sponsored retirement savings plan that allows you to save and invest a portion of your paycheck, in some cases, up to $81,250 in 2025. I'll explain that in a second. I know you think that's probably not right. And here's where it really gets interesting, is that there are different types of contributions you can make, some of which you may not have heard before, and each of them with unique benefits. So let's break it down. So what are the types of contributions you can make to a 401k? The first type of contribution is one that you're most likely familiar with: salary deferral contributions. This is the part of your paycheck that you put directly into your 401k before it even hits your bank account. In 2025, the employee salary deferral contribution limit is $23,500, and there are two main options. Traditional 401k contributions, right? These are contributions made with pre-tax dollars, meaning you get to reduce your taxable income for the year by using one of these. So for example, if you made $100,000 and you contributed $23,500, you only pay income taxes on $76,500 for that year. When you withdraw funds in retirement, you pay income taxes on your contributions and earnings. But let me ask you a question. Would you rather reduce your taxes now or pay nothing in retirement? Well, that's where 401k Roth contributions come into play. With Roth contributions, you contribute with after-tax dollars, which means you don't get a tax break now, but here's where everything changes. When you withdraw in retirement, both your contributions and earnings are completely tax-free. This is a game changer for many because you're essentially locking in tax-free growth forever. But what about if you're age 50 and older? Well, if you're age 50 and older, there are catch-up contributions to help you save more, and the rules for these have changed in 2025. So if you're age 50 to 59 or 64 and older, you can contribute up to an additional $7,500. But if you're in the age group of 60 to 63, you can contribute up to $11,250 more. So if you're keeping score at home, that's $31,000 if your age is 50 to 59 or 54 and older. And while you're age 60 to 63, that's $34,750. Now let's talk about employer contributions, because this is one area where I see people leaving money on the table. Your employer might contribute to your 401k through a match or profit sharing. Matching contributions, these are if you don't own your own business, then think of this as like sort of free money, okay? Many employers match a percentage of what you put in, and it's one of the best ways to boost your retirement savings. There's also something called profit sharing contributions. Now, these are really if you're a business owner yourself, and while it's not exactly free money, you can contribute even more through the profit sharing, and you can match up to 25% of your gross wages. Also, regarding matching and profit sharing contributions, thanks to the recent changes with the Secure Act, they can be either pre-tax or after-tax, giving you even more flexibility. Now, here's something most people haven't heard about: the mega backdoor Roth strategy. This is the third contribution type and is a strategy available to you if your 401k allows for voluntary after-tax contributions beyond the standard limits. It's incredibly powerful for investors who want to contribute even more than the standard amounts we already discussed. Occasionally, voluntary after-tax contributions are available if you work for a large employer with a 401k plan, but it's much more common with solo 401ks used by small business owners. The two-step process for this is, number one, you got to make a voluntary after-tax contributions. And let me unpack that a little bit. Let's say your compensation is $70,000 in 2025. Well, as you just learned, you can defer $23,500 into either a traditional or Roth 401k using the salary deferrals, right? But then you can take the rest of your compensation, which in our case, if you're following the math, is $46,500, and make the voluntary after-tax contribution. The second step in the process is that you need to perform what's called an in-plan conversion to convert those after-tax dollars into a Roth account. You can do that with either the 401k plan or by rolling them into a Roth IRA. This allows you to significantly boost your retirement savings, and especially so in the Roth account, creating even more tax-free income when you retire. If you're thinking, this sounds too good to be true, I'd never heard of this, I guarantee you it's entirely legal and you can save a lot of money in taxes in the long run. Now, before we discuss tax-savvy withdrawal options, let's talk about alternative ways to invest your money with something called self-directing. Self-directing your 401k gives you the power to invest in what you know best. Instead of being limited to traditional investment options like stocks or bonds or ETFs, those are the type of plans that are offered by your employer sort of plan, right? That's what you're kind of accustomed to at this point. But a self-directed 401k allows you to take control and invest in areas that you believe in, areas where you have expertise or specific knowledge. Imagine being able to invest in private equity, a small business, a real estate, or even cryptocurrency. By self-directing, you're no longer confined to what's available in the typical 401k lineup. The beauty of a self-directed 401k lies in its flexibility. If you're knowledgeable in real estate, you could invest in rental properties or commercial real estate and generate cash flow while still benefiting from tax-deferred growth. Or perhaps you're interested in private equity. You could fund a small business that you believe has tremendous growth potential. If you have specific expertise, you can use it to target investments that could yield higher than normal returns than traditional, sort of like mutual funds, right? It's about putting your money where you know there's value instead of relying solely on market trends that are largely out of your control. Self-directing can be a game changer, especially if you believe your skill set can help grow your retirement savings beyond the typical options. By the way, if you're finding this content helpful or you learned something that you haven't even heard of about before, do me a favor and hit the like button, subscribe to my channel, and click on the notification bell so you don't miss any of these tax saving strategies. Also, drop a comment if you have questions about your 401k. I'd love to hear from you. Now let's transition to accessing your 401k savings, specifically some of the withdrawal rules, okay? We're gonna cover these in after age 59 and a half and before age 59 and a half. But once you hit age 59 and a half, you can start withdrawing without penalty. But here's where a lot of people make mistakes. Traditional 401k withdrawals are taxed as ordinary income, and large withdrawals in a single year could push you into a higher tax bracket. The goal is to withdraw strategically. If you're married filing jointly, you can potentially withdraw up to $100,000 while keeping your taxes relatively low if you plan properly. Usually less than 12% is what you can pay if you keep it under 100 grand. Tax planning, just so you know, it doesn't end when you retire. Entirely new types of tax strategies are available and need to be considered when you're approaching or have already retired. Now, what about if you're before age 59 and a half, right? You haven't quite reached that age just yet. If you need access to your 401k before that age, you're usually looking at a 10% penalty. But there are exceptions, many of which you might not be aware of. So let me mention a few, and I'll provide you with a link in the description below where you can read more about them. One of them is called the Rule of 55. If you leave your job once attaining age 55, you can withdraw penalty-free from your current 401k. The key is here, it's your current 401k. So what's sweet about this is if you've had multiple employers while you've been working and you've had 401k plans at each one and you roll them into your new 401k each time, you now have access to all of your 401k funds. The point I'm trying to make here is the rule only applies to the funds in the 401k plan that you just separated from service from. Now, there are other types of withdrawals, right? There's withdrawals for disability or the SEPP, hardship withdrawals, medical expenses, and even birth of a child. There are ways to access your funds without penalty. But these ways that I'm about to go into, they require specific conditions, okay? So if you've become permanently disabled, that's one way you can get access to your funds. Another way is by taking a series of substantially equal periodic payments, aka the SEP, the SEPP, based on your life expectancy. A third way is if you're experiencing significant hardships. Some plans allow hardship withdrawals for specific financial needs. There are others that you may not be aware of, such as if you incur medical expenses that are over 7.5% of your adjusted gross income, and if you have a child, you can withdraw $5,000 for expenses related to the birth or adoption of a child. Again, I'll put the link in the description below that lists over 15 scenarios where you can take an early distribution from your 401k and avoid that 10% penalty. As I mentioned earlier, I help small business owner save thousands of dollars in taxes. Imagine joining Daniela, who saved over $30,000 in her first year, or Jeff, now saving over $25,000 annually, or Valerie, who just saved over $10,000 in her first year alone. And there are many others who have saved thousands using these strategies. These results are possible thanks to my unique 3-step process to unlock your tax savings. So the first thing you'll do in the course is you'll learn how to build a strong foundational understanding by me teaching you how business taxes work and the accounting fundamentals. So in this section, you'll learn about the various taxes your business faces, different tax classifications, how your business structure affects your taxes, and plus you'll master the accounting equation, journal entries, the profit and loss statement, the balance sheet. Many students say that they get their money's worth from that section alone, but that's just building the foundation, right? But after that, you'll learn the powerful tax strategies and nothing is held back. You'll discover how to save thousands with an S corporation, hire your minor children and reduce your taxes, and how to contribute over $70,000 to your retirement account, right? We discussed that in this video. And third, you'll implement what you learned step by step with me. Together, we'll put these strategies into action using QuickBooks, ensuring you save every possible dollar. This isn't just about learning tax strategies, okay? That you can do on YouTube. It's about implementation so you actually realize the tax savings you've learned about. Most students complete the course in just a few weeks, and here's the best part. I offer a 30-day money-back guarantee, so there's no questions asked about that. The risk is all on me. So if you're ready to start saving thousands of dollars, visit navimuradcpa.com or click the link in the description below to learn more and preview the course content. If you learned something in this video, subscribe to my channel and click on the notification bell so you'll be alerted when the next one is released. Or if you can't wait and want to learn more right now, click right here to watch another one of my valuable videos. I'll see you there or in the course.